Tyler, right now, a lot of stocks are up. It's been a pretty solid year and a half nearly at this point for a ton of stocks out there. And you and I both have done our share of adding to our winners, buying stocks that have gone up in value. But that doesn't mean that that's the only place to shop. There are a lot of stocks that are down that we see good high quality businesses that it's an opportunity to buy on the dip. I've got one. This is going to be a fun conversation.
Hey man, there's not a lot of buying opportunities out there, at least in my opinion, especially in well-known companies. So to find some of these bargains, it's kind of interesting in a bull market like this.
All right, before we get going, just a reminder, this video is sponsored by The Motley Fool. We got two great stock ideas for you right here on this video. To get The Motley Fool's 10 best stocks to buy right now, just go to our special link. You see it on the screen. It's fool.com/unscripted. Again, fool.com/unscripted. Go to that link after watching this video. Okay, Tyler, you go first.
All right, so I've mentioned this one before, and maybe I haven't banged you on the head enough about whether or not this is a company worthwhile. But let's go with Canadian Solar. It's actually up quite a bit in the past couple of weeks. I don't know if you've noticed, but Canadian Solar, First Solar, have had a pretty spectacular run over the past couple of days. It's been a good run, but at the same time, Canadian Solar is still down about 25% for this year. There was a point it was down almost 45%, so it kind of gives you an idea of the run that it's had in the past couple of days. But I know you and I have talked previously about First Solar, for example, because we've talked about the high interest rate environment, and that has been a struggle for a lot of solar development, especially in the residential space, because it's an expensive thing to do at high interest rate environments. But utility is still doing very well because most of the utility purchases are what we would call kind of in backlog, right? We've talked about First Solar having this very large backlog, and Canadian Solar is not that different. As a utility provider, it also, some of its panels do go to residential, some go to like those rooftop commercial installations as well, but utility is kind of the name of the game for them. Similarly, they are seeing massive backlog orders. Their backlog is multiple years out from what they actually have selling right now. They're doing a large expansion project on their actual production. And after a couple years of weaker pricing, they're starting to see some improvement on the actual sales of its panels itself. They also have an in-house development arm, which I think is part of the reason why it tends to trade for a little bit more of a discount to First Solar, which is a pure panel manufacturer. The kind of housing a project and development and then try to find a seller later on, it makes sense, but it makes its earnings very lumpy, and people kind of don't necessarily like it without versus like First Solar that kind of had that at one time but decided to dump it. The reason that I'm looking particularly at Canadian Solar right now is because despite the recent run up, like I said, it's still down 25%, but it is trading for what I would say is an extremely cheap valuation for something that has a lot of revenue visibility for the next several years. As of right now, it trades for about 6 times earnings, and its price to book value is about 0.5 times its book. And this isn't a distressed book, it's over leveraged or something like that. As of right now, they have about $2 billion in cash on the books, and this is a $1.3 billion market cap stock. And so it kind of gives you an idea of like, yeah, there's some, it's maybe not the best time in the cyclical industry that is solar, but with the value that I think you can get over on a company like Canadian Solar over the next several years, I think it makes a lot of sense.
Yeah, a couple of things to highlight there. A lot of times, if you see a company trading for a big discount to book value, it's because it's a troubled business, right? Maybe they're burning cash. They have a tremendous amount of debt. They're going to struggle to service. So that book value is discounted to adjust for the reality that some of the existing book is going to have to cover debt and is not going to be able to get turned into cash that flows to equity investors. But like I said, that's not the case with Canadian Solar. It is a solidly profitable business. Yeah, it has a bunch of debt, but the debt's well within its ability to cover and maintain. That large cash cushion also can help it get through cyclical periods. Like I said, right now is a good time for utility scale solar, but if the business does weaken, that cash is a great cushion for the business during that period. So I think you're right. This is one that I own too. And I think patient investors are definitely going to be rewarded by buying this stock right now, and the market will reward them over time. I'm going to talk about one that's a little more popular that it's kind of a similar story. It's the stock's down a ton. It's down about 31% since the beginning of the year, even as the business continues to perform pretty well, and that's SoFi Technologies. Anybody that's been on the internet or watched a football game or looked for a new bank or refinancing a student loan or something like that, you know who SoFi is. They're pretty popular. They do a lot of marketing for customer acquisition. And the thing that's really interesting to me about SoFi right now is that I'm going to share the chart here just to show how much the stock price has just kind of come down this year. Is the stock price has come down even as the business has done quite well, and they've raised their guidance, improved their outlook. So I'm going to bring up the guidance really quick. I'm not going to get into the details. I'll say before I kind of go over the guidance, still growing really quickly. They're adding new customers for banking and other financial services. Like they do, they have a brokerage for stock investing, student loans, refinancing, personal lending, mortgages. They started doing mortgages, and they're at a point now where they're expecting for their full year to be profitable. This will be the first year the company's ever actually been profitable on a GAAP basis. And they raised this guidance for GAAP net income to 170 million, which is great. And then you look at book value, tangible book value, they're expecting to basically double the amount of book value they're going to grow this year. So the business is growing really, really well. They're reaching profitability this year. And then you fast forward it out a little bit. I want to just share this and actually talk about the stock price. At this point, the stock price is less than $7 a share. On a multiple basis, they're looking out to 2026. You're able to buy it for a single digit multiple for their expected GAAP earnings in 2026. So there's a lot to like. I'm going to take it one step further. A differentiator for SoFi versus a lot of the legacy banks, a lot of those legacy banks have a tremendous amount of low yielding debt from, the past few years before interest rates started to go up, when everybody and their cousin refinanced mortgages, less than 3%, some close to 2% for some 15-year mortgages. So lots of legacy banks are loaded with that low yielding debt that affects their interest margins. If you look at this is off the FDIC's website. If you look at SoFi, their net interest margin is over 6.7%. So that is, even though you can get they pay some of the highest yields on deposits, their cost of funding is 3.5% on average. And you go open a deposit account there, they'll pay you 4% yield plus. They're still earning 6.7% net interest margin because they're not encumbered with all those cheap yielding loans, and they've built a loan book on more current rates and some higher rate products, and they've done really, really well. So I think you've got a couple of different options here, right? You're looking at something in a cyclical industry that struggled, but one of the best operators with Canadian Solar, great balance sheet, well protected. They focus where they're really good. And then if you're looking more for maybe a growth industry opportunity, but still what to me looks like a deeply discounted business that's incredibly well run, you've got SoFi Technologies. So a couple of great choices there for stocks you can buy on the dip right now.